I'm Stan Barnes, and I'm here with Eddie Hatch, and we're Barnes Capital Group. Welcome to the 11th edition of Barnes Quarterly. Springtime here in Tallahassee, and it's been kind of up and down in terms of the weather, but today is a nice day. We're coming off of a action-packed weekend where just finished up the Masters Golf Tournament, which is always exciting. And here in Tallahassee, we had Word of South as well as Due South up in Thomasville and the spring game at FSU. So everything seems to be falling back into place after a couple of years of coronavirus, and people getting back to normal and excited to be getting together once again. Today we've got a guest speaker, Liz Murphy, who is CEO of Early Learning Coalition here in town. And as you know, we have traditionally tried to feature non-for-profits doing good works here in the community. So we're excited to have Liz here today. We'll also have our standard guest, Chris Zaccarelli, who will be catching us up to date on what's been going on in the markets and what we should be paying attention to going forward. We'd just like to welcome Liz Murphy, CEO of the Early Learning Coalition here in Tallahassee, to Barnes Quarterly. And we have had the good fortune of working with Liz and her team for a number of years, and Liz has served in several different roles since we've been involved with ELC. But just, Liz, well, number one, welcome, but talk to us a little bit about who ELC is and what you do, what your mission is.
Sure. So thank you so much for having me today. So ELC is a private, not-for-profit organization that serves 7 counties. So we serve all the way from Liberty, Gadsden, Jefferson, Madison, Wakulla. I'm sure I'm forgetting one of my counties, but I'll repeat them. Gadsden, Jefferson, Leon, Liberty, Madison, Taylor, and Wakulla. And ultimately, our mission is to provide leadership and advocacy that prepare children for success in school. So we receive funding from the state of Florida, and we help provide tuition assistance for families that can't afford the total costs of childcare. We also administer the Voluntary Pre-Kindergarten Program, which is VPK to most, for the state of Florida for these counties as well. We currently serve about 6,000 children in these counties, and we work with a little bit over 200 child care providers to ensure that they are providing the best education to set these children up for success in school so that when they're transitioning into kindergarten, they're ready. So that's ultimately what we do. I mean, we do a whole lot more than that, but that's what we're most known for.
Well, I mean, that's got to be tremendously gratifying, I would think, to get kids started on the right path early on. How large is your team here in Tallahassee?
So we are about 45 strong. Yeah, we're about 45 strong for a lot of for a lot of footprint that we have to make sure that we capture.
So your one office of the team of 45 covers all those counties?
Correct.
Okay.
Yeah, there's 29 other coalitions in the state of Florida, and for a total of 30. So, and
talk to us about your funding. How do you have the money to keep your doors open? So
sure. So our funding comes through the feds, then through Department of Education, then down to the Division of Early Learning, and then ultimately to us. We are a direct service provider. We oftentimes, the staff consider us a pass-through because most of our money goes directly to direct services. So we have to keep a very low percentage for admin of these programs, but most of it is direct services going right back into the community.
So how does your clientele hit your radar screen? I mean, how do you market yourself in the community, or who connects you to these kids that you're helping?
Sure. It's a collaborative effort, so everyone plays a part. We right now we are immersing ourselves in our communities because, as I mentioned, some of our communities are a little bit more rural. So we have to do things such as radio ads. We have to do billboards. We have to do bus stop advertisement. We have to do work with other partners like DCF and other referring agencies to make sure that they know the services that we provide, and we're constantly educating because our services also are not just for families, but they're also for students. Okay. And so we make sure that we partner with the right organizations because we need them. We have learned that the best advertisement is word of mouth. And so when you provide a great service to one family, they tell their friends and it continues on like that. So, but we do whatever we can to immerse ourselves. We work really close also with the school districts.
Okay, very good. You've been with the ELC for how long now?
15 years.
Wow. And we were happy to hear you say that you didn't know ELC without Barnes Capital being involved. Yeah. So that's what we shoot for.
Yeah.
Okay.
Liz, is there a way for, or how do the listeners or people like myself, how would we get involved with ELC?
Sure. There are different ways. First, visit the website. We tell you different ways that you can volunteer, what those opportunities look like. You can serve as a celebrity reader. We call it that because to a child, any adult that is new to them might be perceived as a celebrity. And so I just mentioned earlier that I was Ada Twist this weekend, and the kids actually thought I was Ada Twist. And so to them, I was a celebrity, and I sat there and I read books. But you can do something. If you can't donate your time, your gift of time, you can donate your gift of financial resources. We also have a book Amazon cart. And so I would say visit our website at elcbigbend.org, and you'll find out all the different volunteer opportunities and also ways to donate. We're here for the children, and we meet families where they're at. You know, during the pandemic, some families were not ready to send their children back. And so we had to make sure that we pivoted as the family needs pivoted, and to ensure that if they were ready to send their children, that we were able to show them which child care centers were open that had capacity. We've experienced some different unique circumstances during the pandemic that the community recognized, and they rose to the occasion, especially as it comes to essential workers. Essential workers had to show up to work because they had to administer vaccines, take care of those that were sick and all that. And usually that's not a demographic that qualifies for our services. But we were so fortunate to work with the city, and they were able to provide us with additional financial resources that allowed for us to serve those families. And that was so amazing because not only were we serving the families, the 6,000 plus families, we were also serving an additional 500 that were kids of essential workers. So that was something that I never thought I would see. But it's been amazing to see what people and what resources showed up during the pandemic. And I just didn't want to not mention that because there was some good that came out of it, you know?
Liz, we really appreciate your time this afternoon, and glad our listeners can learn a little bit more about Early Learning Coalition, and we also appreciate the relationship you've had with Barnes Capital for these many years. It's been great, and look forward to the next 15.
Yeah, thank you so much for having me. And thank you also for your partnership, because we were able to celebrate 20 years this year, and you were part of that.
Oh, wow.
You were part of that, so thank you so much for that.
Absolutely. So there's obviously no shortage of topics to talk about in the markets right now, and so, but it seems to me that sort of at least three of the major themes are obviously interest rates, which we've started to see some movement in. inflation, and then, of course, the situation in the Ukraine and what sort of collateral effects that may have on the rest of the world. But I'd say just pick any of those and let's launch in and sort of help our audience understand the ramifications of each of those.
Yeah, absolutely. And all three of them are definitely kind of foremost in most people's minds right now. And they're all interrelated if you think about it, to the extent that what's happening in the Ukraine is causing increased inflation. It's more disruption potentially to the energy supplies, more disruption to commodities in general. And so that has an impact on inflation, typically pushing inflation higher. And as a result, markets around the world are pricing higher interest rates, partially reflecting the fact that there's going to be higher inflation, but also partially reflecting the fact that they expect central banks to meet the inflation challenge by raising short-term interest rates. And sure enough, the Federal Reserve Bank in the U.S. has already done 180 degrees from last year, where they had intended to keep interest rates low for a long period of time, to just as recently as a week or two ago saying not only are they going to be raising interest rates, but they might be moving them at 0.5% or more at each meeting, whereas in the past they typically only moved at 0.25% in a slow, measured fashion. So there's a lot of moving pieces today in the world.
Well, there's been a lot of discussion about how aggressively the Fed's going to move interest rates upwards, and I think there were some comments from Brainerd maybe last week that sort of shook things up with the market after having a couple of weeks of pretty decent performance. But what was that all about?
Well, I think the Fed has been a little bit slow to recognize the problem with inflation. For a long time, they've been talking about how inflation would be temporary and that it was purely caused due to what was happening with supply chains and really the COVID pandemic. But there was a smaller group of people, of which, I was in that camp even a year ago, that were concerned that there was so much money printing as well as fiscal stimulus in terms of the federal government putting a lot of money into the hands of consumers, that ultimately all of that money would eventually cause an inflation problem. And as the Fed is starting to come around to the idea that there's an inflation problem, we've been seeing higher and higher inflation rates in the economic data. So what was a theoretical issue of a problem of increasing prices is now very much an actual problem. And so I think the Fed has realized that they need to move a lot more quickly than they originally anticipated. And so in order to really show that they're serious about fighting inflation, they can no longer afford to be patient or to move in measured fashion. I think they have to move a little bit more forcefully and a little bit more quickly. And that's what you saw as recently as last week.
Okay. Let's go to where the rubber meets the road, so to speak. And that is, what are you doing with your portfolios in terms of adjusting to the current conditions we find ourselves in?
So for the last year and a half, I've really been trying to balance the portfolios out, start to introduce some inflation hedges. And so there's a lot of different portfolios. Some portfolios have individual stocks. Other portfolios will have mutual funds. But whether it's adding master limited partnerships as terms of an ETF in an individual equity portfolio, or adding mutual funds with some master limited partnerships in terms of energy pipelines, slowly kind of adding some of these inflation hedges into the portfolios. And so if you look at other moves that we've made, depending on which portfolio people are in, cutting back a little bit on small cap stocks, those smaller companies that are more likely to be pushed around in the event of more volatility in terms of difficult economic conditions, as well as looking to just diversify the portfolio more broadly, looking to be slightly larger cap, larger companies, and potentially even being a little bit more international, which may sound a little counterintuitive if you think about the U.S. being the strongest economy in the world. It's also the most expensive stock market in the world. So one of the dynamics you have to worry about as you hit market volatility is that not only will you see the impact on companies, and typically larger companies will do better than smaller companies, but you also see that impact on stock prices. And the more expensive a stock is, the farther it has to fall, as opposed to less expensive a stock. So some people will talk about value stocks versus growth stocks. And growth stocks are really anticipating a lot of optimism in the future and looking for a lot of revenue growth or earnings growth. And so all things being equal, that's preferable to a company that's not growing as quickly and is not sure and steady. But as a market cycle extends and gets longer, those types of companies typically demand a higher and higher premium. And so as those premium is put on those earnings on the way up, it's also taken away on the way down. And so some of those companies that have been the quickest to shoot up in price, they can also be the quickest to fall in price. So it's changes like that along the margins, as well as kind of looking at the philosophy of the portfolio that over time you want to slowly be moving, changing direction slightly. We want to have a long-term perspective. We want to be invested for 20, 30, 40 years. But in the short run, there are some small course corrections you can make so that things are either less bumpy in the short run, or that you can preserve a little bit more value so that as events unfold, you have an opportunity to again become more aggressive when you're at the end of the cycle. I would work towards the later end of the bull market cycle, and so it's time to start thinking about when will this bull market end and how do you position yourself for the next bear market.
Okay, so you kind of covered if an investor is already in the market, what sort of adjustments are being made. But we've been fortunate enough to have a couple of situations where clients have had liquidity events and they, as a result, are sitting on of cash that need to be deployed. And if you could just talk a little bit about the strategies you're using if someone is not invested in the market and has money to put to work, how might you go about doing that?
So as far as, let's call it cash on the sidelines or money that's not in the stock market or bond market yet, for the example, given the examples that you've mentioned already, one strategy that can be used is to dollar cost average. And by that, I mean breaking up the cash that's available to invest and putting it into the market slowly, whether that's the course of weeks or months or even quarters, depending on what your investment time horizon is, but slowly buying into the market. To the extent that the market keeps going down, you want to keep buying at lower and lower prices. However, no one knows when you're going to hit the bottom, and so the last thing you want to do is just be waiting for that perfect moment for the stock market to sell off dramatically. That moment may never come, in which case the market eventually finds a bottom and keeps moving higher, and you don't want to miss out on that upside. So really the dollar cost averaging approach is one of the better ways to enter a market that's trending the way this current one is, because without knowing exactly when the bottom will come or if there'll be some type of dramatic drop-off, you do want to continue to buy into these markets. Over long periods of time, the kind of fluctuations that we'll see over the next few months and few years, there's not going to be as big an impact on your portfolio over 20, 30 years. But over the next 6 months, 1 year, 2 years, you can have a pretty dramatic impact. So what you want to do is try to optimize as best you can for the short run while keeping your eye on the long run, which is ultimately all of our goals.
Very good. Well, as I see people out and about, they ask me when the markets are choppy as they are now, have you been getting a ton of calls from people that are nervous about what's going on and that kind of thing? And I hopefully through this medium and others, we've done a decent job at letting clients know how to navigate environments like we find ourselves in right now. Generally speaking, what we tell them is to stay the course. It's a good time to sort of reassess and reevaluate how they're invested and what their goals and objectives are. But let me let you sort of articulate what the strategy should be.
Well, I think that's exactly right. I think as stock markets go higher and higher, it's very easy to fall into the trap of wanting to take on more and more risk. So for those people who have a long-term horizon, they may think they want to own 100% stocks and not own any bonds. Or for those people who typically, through difficult periods in the past, have done best, let's say, half in bonds, half in stocks, they start to want higher upside, and so they may move some of their portfolio from bonds to stocks. And that's a really difficult thing to do because effectively, as the market's going higher, you're buying higher and higher, and eventually the market will go back down. That's the one thing we do know about stock markets especially, is that they're volatile. They go up and they go down. Over time, we've been fortunate in that we've seen stock markets trend higher over the longer periods of time. And that's our expectation for the future. As long as we believe the economy, all things being equal, will continue to grow over longer periods of time, and therefore we expect corporate profits to grow, all things being equal over longer periods of time, we will expect higher stock prices in the future. But the trade-off you get for that growth above and beyond what you could get with treasuries, the so-called risk-free rate, is that there's volatility. And so volatility, unfortunately, means your account balance can fluctuate pretty dramatically. And so whether a fluctuating account is something that makes you get concerned and want to get out of the stock market and effectively sell low and lock in your losses, or whether you're in retirement or you have other liquidity needs, you need to pull money out of your account, it's in your best interest to have a portion of your account that's more stable, either to keep you invested for the long term, or to be able to pull out in the event of either a scheduled or an unexpected need in order to pay for things. So our advice, and I know, Stan, you agree with this, is to make sure that you have the correct asset allocation. Make sure that you have the right percentage of stocks and bonds, and over time you can rebalance that. So when the market does have those drops, rebalance so that you're effectively buying low in the stock market. And likewise, as the stock market hits all-time highs, you want to have the opportunity to rebalance as well and try to sell high a little bit. So over time, if you can maintain that right balance between stocks and bonds, and there's also commodities and cash that will be in that picture, but it's largely stocks and bonds, that's typically the best path and the best strategy for good performance over time. And ultimately, it's really important to make sure that when the stock market's at all-time highs, we don't get overly aggressive. When the stock market's at near-term lows, you don't want to get overly pessimistic. The most important thing you can do is have a good plan and stick to that plan. And so ultimately, the best time to plan is before something dramatic happens, positive or negative, because we all know that our emotions can get the better of us in the good times as well as the bad times. And so the most important thing of your plan is making sure that you're able to execute your plan and make sure that your emotions never overwhelm what's otherwise a good, logical plan going forward.
Chris, as inflation is starting to rise and interest rates are starting to bump up as well, and the speed at which they're rising is starting to increase as well, and the R word is starting to be tossed about in some areas as well. As we have these upticks in the market, are you taking those opportunities to raise cash, or are you just rotating into more inflation-protected instruments and then trying to reallocate as we hit troughs in the market as well?
Yeah, so, ultimately, most of what we're doing with the portfolio is doing more of the rotations, the kinds we talked about a little bit earlier in the conversation, as far as looking at where valuations are lower versus higher, and looking for those types of companies that are a little better positioned in case we do go into recession or have economic difficulties. The one certainty we have is that stock markets won't keep going higher forever, but also they won't keep going lower forever. And unfortunately, every bull market will end, and unfortunately, every business cycle will end, and we can't expect the good times to last forever. As we get later in the economic cycle and we get later in the bull market cycle, it's important to make sure that the kinds of companies that we own are those bigger, stronger companies, but also those companies that are not too expensive. And so it becomes a challenge when there are some of the best companies in the world that are also some of the most expensive companies in the world. And so it's a constant balancing act between evolving the portfolio. Within an individual equity portfolio, we will raise a little bit of cash, not too much, in order to have an opportunity to buy on the downside. For the most part, in the mutual fund portfolios, we won't create too much excess cash, because the mutual fund portfolio managers that we're using are also going to be raising some cash. But in general, the idea is if you constantly evaluate the opportunities, continue to rotate into areas that are more attractive versus less attractive over longer periods of time, that's the best way to have the best relative performance, given that no one knows exactly when that day will come, when the bull market will end or when the bear market will end. And likewise, we just want to make sure that the money is protected for the long haul, not worrying so much day to day what's happening with the stock market, but what's likely to happen over the next 10, 20, 30 years.
Well, there's certainly interesting times. Just to put it in perspective, I was reading a piece this morning that sort of reviews the market conditions, and as far as interest rates go, what everybody tends to key off of is the 10-year Treasury. And it was noted that it's currently, or as of last week, it was at 2.71%, which is the highest that it's been in 3 years. And as far as the inflation rates that are happening now, they are the highest that we've seen in 4 decades. So am I right there, Chris?
Yep, those statistics sound exactly right.
So that is significant. It's not something to panic over, but it is worth noting that we've got probably a different environment moving forward than we've had in recent history. So just would like to thank you for your time today, and thanks for giving us your wisdom on the markets, and we'll be in touch.
Thanks, Dan and Eddie. Always great talking with you and great having this opportunity to speak to your clients.
Chris Zaccarelli of Independent Advisor Alliance and Liz Murphy of Early Learning Coalition are independent entities and not related or endorsed by Barnes Capital Group or LPL Financial. There is no assurance that the techniques and strategies discussed are suitable for all investors or will yield positive outcomes. The purchase of certain securities may be required to affect some of the strategies. Investing involves risk, including the potential loss of principal. The economic forecasts set forth in this material may not develop as predicted, and there can be no guarantee that the strategies promoted will be successful. Dollar cost averaging involves continuous investment into securities regardless of fluctuation in price levels of such securities. An investor should consider their ability to consider purchasing through fluctuating price levels. Such a plan does not ensure profit and does not protect against loss in declining markets. Asset allocation does not ensure a profit or protect against loss. This material contains only general descriptions regarding insurance needs and products. This content is not a solicitation to buy, sell, or replace any existing policy. Please speak to a financial professional regarding your specific insurance needs prior to taking any action. All performance reference is historical and no guarantee of future result. The opinions voiced in this show are for general information only and are not intended to provide specific advice or recommendations for any individuals. To determine which investments may be appropriate for you, consult your attorney, consultant, financial advisor, or tax advisor prior to investing. Securities offered through LPL Financial, member FINRA SIPC. Investment advice offered through Independent Advisor Alliance, a registered investment advisor. IAA and Barnes Capital Group are separate entities from LPL Financial.